Good day, students, and this is Professor Alexander Buchholz coming to you for our Chapter 15, dealing with partnerships, termination, and liquidation. So let's take a look at our particular chapter today and kind of see where it takes us from there. Several different learning objectives here. So this chapter is now taking us to the angle of we started a partnership, but partnership just didn't work out for whatever the reason may be, as sometimes does happen. Um, we enter into a partnership, we don't get along with another partner. We enter a partnership and, excuse me, we don't like the business that we're in. We see the business we're in isn't functioning as it should be. So again, for whatever the reason, we decided to terminate our partnership. So our learning objectives, number one, describe the steps used to distribute available partnership assets in liquidation under the Uniform Partnership Act. List the order of priority for each class of creditors in partnership liquidation. Prepare a liquidation schedule to settle debts and allocate assets. Prepare a safe payment approach liquidation schedule. Describe the 4 steps in the preparation of an advance plan for the distribution of cash in a partnership liquidation. Prepare the journal entries to incorporate a partnership. So, steps in the liquidation process. Now, what we're going to see by a schedule is that the first step is always to determine what was the net income or net loss up to the date of dissolution. The closing process obviously should be completed for the year, so everything posted in the general ledger, and any net income or loss should be allocated to the partners in accordance with their profit and loss agreement. The second step, those assets not acceptable for distribution in their present form are converted into cash. The last step, as we'll see, is to distribute the assets to creditors and partners. And we follow generally the provisions of Section 40B of the Uniform Partnership Act. Section 40B of the Uniform Partnership Act, liabilities are ranked in order of payment as follows. Number 1, liabilities to creditors other than partners. Liabilities to partners other than for capital and profits, meaning loans. And liability to partners in respect of capital. And the 4th, liabilities to partners in respect of profits. So we kind of have a first review question here. The first step in the liquidation process is to, and hopefully you've answered choice C as in Charlie, compute any net income or loss up to the date of dissolution. Let's talk about priorities of partnership and personal creditors. So under the Uniform Partnership Act, it provides that partners are jointly liable for any and all contracts and other obligations of the partnership. There is an order concerning the availability of the assets. Partnership assets, okay? So again, partnership creditors, personal creditors that did not recover their claims in full from personal assets from, again, personal creditors, partnership creditors not satisfied from partnership assets, claims of partnership against partner with deficit equity. So again, remember the partnership, a little bit different than a corporation. There is unlimited liability. We as a partnership are unprotected. So if somebody wants to come after our personal assets, they have the right to do so. Again, that's one of the drawbacks sometimes in dealing with a partnership is that unlimited liability. So that is something to consider. That is something to advise clients if ever you are in a position to advise somebody on that angle. So review question, true or false? Personal assets are first allocated to partnership creditors, then to personal creditors. And the answer there is false. Review question. If a partner with a debit capital balance during liquidation is insolvent, the following results. A, the partner must borrow money to invest in the partnership. The partnership will give the partner cash to the extent of the partner's debit balance. The partner's debit balance will be allocated to the other partners. Or letter D, none of the above. And again, hopefully you've answered C as in Charlie. The partner's debit balance will be allocated. Review question again. In accordance with the marshaling of assets provision of the Uniform Partnership Act, rank the following liabilities of a partnership in order of payment. Number one, $20,000 loan from B. Barry, who is a partner, $30,000 of profits from the last year of operations, $3,000 payable to a supplier, $100,000 in capital balances of the partners. So again, hopefully over here you've answered, yet again, choice C as in Charlie, $3,000 payable to a supplier is number one. $20,000 loan from B. Barry is number two. $100,000 in capital balances of the partners would be number four, and $30,000 of profits from the last year of operations is two. Let's look at an exercise here so we can see how an illustration would be done for liquidation. Three partners have operated a laundromat for 10 years. The partners have a profit and loss ratio of 4:3. So again, if we wanted to add it up, 4 plus 3 plus 3 is 10. So 4/10, 40% to Pete, 30% to Tom, 30% to Zach. And they've decided to liquidate the partnership. The firm's balance sheet just before the partners sell other assets for $30,000 is as follows. So again, normal balance sheet, assets equals liabilities plus capital, and they equal. Here is the personal status of each partner just before liquidation. So again, looking at the different assets and liabilities, hopefully you realize that Pete and Zach really are insolvent. They do not have enough assets to cover their liabilities. Let's determine the amount of each cash, the amount of cash each partner will receive in liquidation, how much cash each partner must invest in the firm, given their personal positions. So again, part A. So in part A to the process, these are the balances. 15,000, non-cash is 110, liabilities, which represents the credit, is 42, and here are your capital balances. And again, ladies and gentlemen, this is the schedule that we will prepare when doing all of our homework, classroom, and examination questions, because that's how we would do it in the real world. We would do a schedule to show this to our potential partners. We sold the assets and allocation of the loss, sale of assets and allocation of the loss. So what's happened now is we've sold non-cash assets for $110,000. That's the value. But I only sold it for $30,000. Well, if I sold it for $30,000 and it was worth non-cash assets of $110,000, that basically means I've got about $80,000 of losses to allocate. So we have a loss of 80,000. Well, how is the loss allocated? It is allocated in the ratio of the 40, the 30, and the 30. 40% of 80,000 is 32. 30% of 80,000, 24. Our new subtotal over here now shows that cash in the bank is 45,000, remaining liabilities to vendors is 42, and these are our balances left. Now, what you will notice at this time is that it looks as though Tom and Zach have deficit balances. Well, what this now means is, okay, we need additional funds. Now, from the previous slide, you'll notice that Tom has money, but Zach does not. We're going to allocate Zach's balance between these particular partners in their remaining ratio. So right now, all that is left is 40 and 30, which again total to 70. So 40 divided by 70 times $10,000 gets you 5,714. 30 divided by the 70 times 10,000 gets you 4,286. Here is the revised balances. Tom has an even further deficit, but because Tom is solvent, we can call up Tom and say, Tom, can you write us a check for 14,286, which he does. And that covers his deficit down to a zero balance. We invest now and have 59,286 of cash. Well, there are still $42,000 of liabilities, and Pete still has a 17,286 capital balance. We now pay the creditors first, leaving us with 17,286, which is paid to Pete. You will notice that if the liquidation schedule is done properly, which makes sense, look at the last line. It should all be zero. There should be no remaining balance. Part B. Determine the amount that the personal creditors will receive from personal assets and any distribution from the partnership. So right now, again, now this was from that original spreadsheet we showed you of their personal assets, personal liabilities. We see here is excess deficit. Okay. Pete was distributed 17,286. The total payable to the creditors at this point in time would be the 72,286, 10,000, and 30,000. So again, total payable to creditors would be your 10,000 over here. Personal liabilities would be 50,000, but 30,000 here, so he would be liable. So there is a deficit, and total payable to creditors would be 72,286. Installment liquidation. Instead of the immediate conversion of non-cash partnership assets to cash under a simple liquidation, there is a couple of things to note. In the example that we just did, this kind of assumed it moved quickly, but in reality, a partnership can be dissolved over several months, even several years, depending on timing. If you're a partner, you don't want to wait until the end to get a cash distribution. You may want to get some safe payments, some installments ahead of time. So if partners receive cash in installments before the total liquidation losses and total cash available are known, we can do some safeguards to protect the interests of the creditors and the partners. Again, I'm a partner. This is my business. My business is now going out of business. I need money to survive. So that is something very important to consider, that when you're going through a liquidation, which could take several months, several years, you really can't afford to be without cash as a partner, especially if that was your livelihood. So let's talk about something called the safe payment approach. The safe payment approach. And with the safe payment approach, it's based on three assumptions. The three assumptions that it's based on are as follows. Number one, a loan to or from an individual partner will be combined with the respective partner's capital account. Number two, remaining non-cash assets will not provide any additional cash, meaning, again, these are assumptions, that if we have equipment, we will not be able to sell it. And a partner with a debit balance in the capital account will be unable to pay amounts owed. Safe payment schedule is prepared each time cash is distributed. So in this exercise, again, we've got balance sheet, which balances, and we've got partners that share income 40, 40, and 20. Assume that 70% of the receivables are collected and that inventory with a book value of $15,000 is sold for $10,000. All cash available at this time is to be distributed. So again, same type of a schedule, a little bit different though. Our first line, sale of inventory, collect AR, allocate the loss. So, cash coming in the door is $38,000. We've sold non-cash assets for $43,000. Okay. Again, 70% of the receivables are collected, and the inventory with a book value of $15,000 is sold for $10,000. So, we therefore have a loss of $5,000, which was allocated. 5,000 times the 40 is 2,000. 5,000 times the 20 is 1,000. Leaving us with the following. So far, please note, all of our partners remain safe. No partner has a deficit balance. We pay the creditors $18,000 each, leaving us with the following. We now, at this point, wish to make a safe payment. So please note, let's take a detour with the schedule down to the bottom. Here are the capital balances currently on the books. The safe payment assumes, ladies and gentlemen, that we are going to not be able to sell the non-cash assets. It's going to be worth nothing, zero. So the $87,000 gets allocated between each of the different partners, 40, 40, 20. 40% of 87,000 is 34,800. 20% of 87,000 is 17,400, leaving us with the following capital balances. Again, partner B for Brink is fine. Partner D for Davis, we've got a problem now. They have become with a debit balance, and partner O for Olson is safe with 31.6. We allocate the deficit from Davis to Brink and Olson in their ratio. So we say, well, 9,800 needs to be allocated in the ratio of 40. But again, it's 40 out of the remaining 40, and 20 is 60. 40 over 60 times 9,800 is 6533. 20 over 60 is times 9,800 is 3267. And you're left with the following safe. So 1667, 28,333. So that's the payment we're going to give our partners right now. Again, mid-year, because they do want to get some money. Leaving us right now, currently, no cash available. Non-cash of 87, and the partners' balances. Advance plan for the distribution of cash. The objective here is to derive the order and the amount of cash that should be distributed to each partner, such that no partner receiving a cash distribution will have to make an additional investment. Such a distribution plan will bring the balances of the partners' capital accounts into their profit and loss ratio as soon as possible. What's the rationale? Well, once the capital balances are in the profit and loss ratio, no one partner is in any better position than any other to absorb losses. So, what we want to look at is an advance plan for the distribution of cash. Step 1, determine the net capital interest of each partner. Step 2, provide an order of cash distribution in which the ratio of the partner's capital interest will eventually be equal to their profit and loss ratio. Step 3, determine the amount of cash to distribute to bring the ratios of their capital interests into alignment with their profit and loss ratios. Step 4, prepare cash distribution plan. Let's take a look at a problem. They've called on you, this partnership, to assist in winding up their affairs. The trial balance shows you the following. Looking at the following, the partners share profit and losses as follows. Baker of 40%, Strong of 40, and Weak is 20. The partners are considering an offer of $100,000 for the AR, inventory, and plant and equipment. The $100,000 would be paid to the partners in installments, the number and amounts to be negotiated. It wants us to prepare an advance cash distribution plan as of June 30th, 2014, showing how the potential 106 will be distributed as it becomes available. So first would be to determine the net capital interest of each partner. So you'll notice that Baker and Weak did have, if you go back a few, did advance us some money, kind of a loan receivable, which we're going to net. Step 2, provide an order of cash distribution in which the ratio of partners' capital interest will eventually be equal to their profit and loss. Now, here's the key, folks. We're dividing it by their ratios. That means as follows. The partnership as a whole can take $137,500 of losses before Baker is wiped out, making him the highest. Weak, in his case, the partnership can take on $120,000 of losses before he is wiped out. And Strong can take on losses of $112,000. How do they come up with these numbers? 55 divided by 40. 45 divided by 40. 24 divided by 20. Determine the amount of cash to distribute to bring the ratios of their capital interest into alignment with their profit and loss ratios. So, the next challenge is as follows. New schedule, loss absorption power, cash distribution. Okay. The trick is now to make all the partners equal. 137 is the highest. The next highest is 120. Therefore, I would have to reduce this 137 number to 120 in order to make this work. 137 to get to 120 is $17,500. $17,500 basically times that 40%, 17,500 40%, gets you $7,000. That's how much cash I can give to Baker at that point in time. Okay, so again, you're taking the 17,500 and you're multiplying it through by the 40%. This now reduces 120 for loss absorption, 112, 120. Here are our balances, 48,000, 45, 24. So you'll notice that Baker and Weak now are the same. Okay, well, our next task is to get both of these partners to Strong. In order to do that, I need to reduce their balances or pay them out. Loss absorption potential, 7,500 for Baker, 7,500 for Weak, which means to Baker, 7,500 times 40%, I can give him $3,000. Weak, 7,500 times 20%, I can give a check for $1,500. So that's your loss absorption potential, which means that now the remainder in their balances, which is 45, 45, and 22.5, I can distribute in the 40, 40, and 20 ratio. Step 4, now you can prepare your cash distribution plan. So, as we said, the first $17,000 would really be going, as we said, to the creditors. The next $7,000, and again, let's just take a look for a moment. 17,000 is your accounts payable. That's where that number came from. That would go automatically to creditors. The next $7,000 would be going to Baker 100%. The next $4,500 would be going to Baker and Week, again in the ratios 3,000 to 4,500, 1,500 to 4,500. The remainder would go in the ratios of 40, 40, 20. This would be the potential cash distribution plan, assuming the 106,000 was coming through the door. So if you wanted to show these to the partners, they would get a sense that, okay, if we took the 106 offer, Baker would end up walking away with 41,000, Strong with 31,000, and Weak with 17,000. So look at a review question. In a partnership liquidation, the final cash distribution to the partners should be made in accordance with the B, balances of the partners' capital accounts. Another way we can get rid of a partnership is to incorporate. Partners may feel that incorporation is better, limited liability, continues to exist in perpetuity, and you're able to raise additional resources as needed. So when we want to record the incorporation, all the assets and liabilities of the partnership are adjusted to fair value. A valuation adjustment is created to account for the gains and losses. The valuation adjustment is then closed to the partner's capital accounts in accordance with their P&L, and partners' capital accounts are then closed upon the transfer of capital stock to the new corporation. So let's take a look here. This is a partnership. They've decided to now become a corporation. So they've hired you as the accountant to adjust the recorded assets and liabilities to market and to close the partner's capital accounts to the new corporate stock. The corporation is to retain the partnership's books, and the assets of the partnership should be taken over by the corporation in the following amounts. So we've got cash, we've got AR, equipment and insurance. Jan's loan is to be transferred to her capital account in the amount of $6,600. So here's the following journal entries that we need. Number one would be a valuation adjustment to bring things to fair value. So accumulated, the office equipment, allowance for uncollectibles. Again, let's look at the allowance for uncollectibles. The fair value is $2,900. Over here, the allowance is $2,000. So we did take an additional hit that we needed to credit the allowance. Here's your valuation. So that's kind of what this first entry is doing. It then says that Jan loan is being transferred to her capital. So at the end of the day, we're left with a valuation adjustment of $2,700, which each of the partners are taking as a hit to their old ratio balances. So again, 50-50. In Part B, there's now 400 shares being issued, par value of $100, $400, $100, $40,000. We're now putting the Jan capital, really adjusting it with the original balances, $29,400 and $28,000, taking into account that adjustment of the $1,350, and for Jan, her transfer of the capital, the plug number being $21,300. We can prove this out by looking at the valuation of our assets that are being brought over, 61.3 to 61.3. New books established by the corporation. So again, once the new books are established, all the old books should be zero. And asset and liability accounts will be closed, and a new corporation has been established. Review question. If a partnership is undergoing a transformation to a corporation, which of the following is correct? Assets and liabilities are adjusted to fair value in choice A. Choice B, the net assets are distributed to the partners in their P&L ratio. C, the partners receive stock in the new corporation. C, the partners receive stock in the new corporation. And that concludes our chapter on termination and liquidation of partnerships. Again, we invite you to re-look at this chapter before completing any and all assignments that have been given. Thank you very much, and we'll see you online real soon.